Inside segment. Creedy stepping in today for Abigail Doolittle, and I know normally she takes a look at a lot of the market action out there. What have you been looking at today?
Well, we got to talk about tech here because that's really been the story. You have to have tech on your side to really post those pretty monumental gains you've seen in 2020 and 2021. Let's bring in a market expert, though, and that, of course, we go to Alan Nuckman joining us on Options Insight today. He is the chief market strategist at Bullseye Option. Alan, thank you so much for joining us. Tell us what's driving this here, because tech really hasn't had a break since that Black Friday sell-off. Is this simply attributed to those rate hike bets, or is this simply an exit of haven flows? What's driving this?
Well, we could talk about the rate hikes, which have been most widely telegraphed in the history of the world. And I trust what the markets are telling us. And the markets are telling us we're going to get 4 hikes this year and 2 hikes next year and no hikes after that. So that brings us to a whopping 1 and 1.5%. Your last guest was talking about the 10-year yield being above 2%. That's not alarming to anyone, and it shouldn't be. Stocks are still the choice for yield. Now, looking at the NDX had a great reversal on Monday where it tested its support lows, it tested and rejected, and it came back up, and we hit 16,000 yesterday, which was a halfway point of the drop from the top. Now we've got to build on it, but every time in history, the market's rallied and made new all-time highs when it's recovered half of those losses.
So Alan, talk to us about when the dip buyers are going to show up, because at the end of the day, sure, they're rate sensitive. Sure, you have these kind of haven impact on it. But at the end of the day, these are stocks. These are big companies, Microsoft, Apple, that actually have pretty fundamental drivers. So when do we see these stocks actually recover, and to what levels?
Tomorrow's the start. We're going to get the earnings season kick in. We're going to get billions of pure profit from the banks. And you're going to see the fundamental facts in full focus. And that's what's going to be a reminder that this is about earnings and how much corporations make, and we're going to see that from here on out. So we had a little bit of volatility, as we often do, coming into earnings season when there's uncertainty and there's things to worry about, but I'm excited to get this kicked off because we're going to see how much money these companies are making.
Yeah, Alan, I'm with you there because I'm really curious about if you see that kind of big tech move, does it trickle into some of the other kind of subsectors, ESG funds, for example, that are very tech weighted, of course, or if you see the semiconductors following in suit. But you have a trade that I really want to walk through. Tell us a little bit about what you're thinking about how to play this market, anything that's catching your eye.
All right, this is a stock that's bad enough to buy. This is SunPower. SunPower's been between 20 and 30 for 9 months. It's down here on this 20 level to super support. It's 70% off its high, so it's a great risk reward. And it also was down 40% last year. So what I'm looking at is an in-the-money option, my simple stock substitution strategy. I want to buy the June 15 call. Now this option is $5.50 in the money. It's trading for about $6.50. So it's like being long from 15. It hasn't been to that 15 level since 2020. I'm looking for a rebound. I've seen bullish divergence where it made new lows just last week, and it did not make new highs of volatility. So this is the way I like to find pick the bottoms, and I've got until June for this to turn around. If we get a modest move, this option does exceptionally, exponentially well.
Well, folks, you heard it here first from Alec Nuckman joining Options Insight today. He is Chief Market Strategist over at Bullseye Option. We thank you so much for your time. Taylor, back to you.
Thank you.